Hello, welcome to lesson 2 of market structure. In this lesson, we are going to look at the trading range, which is TR trading range. Okay, so uh, this trading range has nothing to do with the consolidation. Okay, and will be defined by the current trend. Okay, so this trading range has nothing to do with the ranging market or consolidation or accumulation. It's a different kind of trading range, right? But it is defined in the current trend. Okay, so in an uptrend, a trading range is defined as the distance between the previous higher high and the last higher low. Okay, so what this means is that if you're in an uptrend, if you have a higher high, this is a higher high, a higher low, okay, a higher high. So now the distance between the previous higher high, which is this, because this is a new higher high. Okay, the previous higher high is this, and the previous or the last higher low is this. So the distance between them, this is your trading range. Okay, this is what it means. Okay. All right. So now, if you have an uptrend, okay, this is an uptrend. We have a higher high, a higher low. Price trades above the previous higher high, giving us what a new higher high. Okay, so the distance between this high, previous higher high, and this higher low is what the trading range. So this is our trading range. So you have a higher high and then a higher low. And in between this is what the trading range. Okay. Now we are looking at this. If the market trades above that level, okay, the distance between this new higher high and this higher low becomes what the trading range. So now we have a new trading range, right? Again, we are looking at this high, looking at this higher high, new higher high has been formed. Price has traded above the previous higher high. So we have a new higher high. If you break that higher high, then we are looking at what? The distance between this higher high and this higher low is what the new trading range. So we are looking at this area. All right. So in a downtrend, a trading range is also defined as the distance between the previous lower low, and the last lower high. So same explanation. Okay. So this is a lower low. The market has traded below the previous lower low. So we are looking at this and this as a trading range. Okay. If we break below this, then we have a new trading range. If you break below that, you have a new trading range and so on. And that is how it works. Okay. So now we have a downtrend. The market trades below the previous low. So we have a new trading range. Okay. Again, we trade below the previous low. We have a new trading range. Then we have a new trading range. So in the next slide, we are going to look at how we use this. Okay. So now how do you use the trading range? We expect the market to pull back into the trading range to absorb internal liquidity. Okay. And to fill inefficiencies. So we are talking about imbalances in the trading range. So when market moves or breaks the previous high, we look into the trading range to see if there are imbalances or inefficiencies or internal liquidity. That is what high short-term highs or lows within the trading range. So we expect to see the market pull back into the trading range to absorb those before moving up. Okay, so now let's say we have a high, we have higher low. The market has traded above the previous high, so we have a trading range. So our expectation is to see the market come into the trading range to do what? To absorb internal liquidity. So we assume this is an imbalance, this is liquidity. So we want to see the market come back. So when we have a break of structure at the top here, okay, then our expectation will be met. We are expecting to see market come back into the trading range. So the decision is in the next slide, but this is our expectation. We expect to see the market come into the trading range. And this is an example. We have a higher high and a higher low. So we have a trading range. Okay. Then the market comes back into the trading range like this, comes back into the trading range like this. And this is where we want to be biased. Okay. So we mark the trading range and expect the market to come in and inside based on, you just need to know the trading range, what the trading range is for now, and our expectation towards the trading range. As time goes on in the course, you are going to understand where you expect a reversal or where you expect to pick your trade in the trading range. But for now, you mark your trading range, you expect to see the market come into the trading range, and inside the trading range, look for what continuation. Okay. So now, 2, know that the market may not come back into the trading range if there is an urgency to sell or buy. So if there's urgency to move the market towards a certain direction, you may not see the market come back into the trading range. Okay. So for instance, in this case, we have a first trading range. The market, we have a high, a low, we traded out. So we have a trading range, which is what the boundaries between this. Sorry. Okay, supposed to be this and this. Okay, this and this. All right, so we have a trading range. The market came back inside the trading range before moving up. Okay, so we have a new trading range, which is this and this. Right, I was right. So it's not this. We have a high, a low, and this is where we had a first break of market structure. So when you have a first break of market, so let's say we have a downtrend, okay, and we break structure, the trading range, okay, is this high and this low. That is where there's a break of market structure. But in this case, okay, this would be the trading range, right? But in this case, when there's a break of market structure, the trading range is what? The high that was broken and then previous lower low. Okay, so this becomes the trading. In an uptrend, it's the same thing. Okay. You have a break of market structure. This becomes the trading range. Okay, so that is why that level was marked. Okay, so now we have a break of structure, trading range. So this is a trading range. Market trades above the previous high. So we expect to see the market come in to fill liquidity, absorb liquidity and fill imbalance. So it came in, okay, but because it's a higher time frame, 4 hour, you're not seeing all the liquidity, but you can see that this is a low that was taken. Okay, so this is liquidity on another time frame. It will look like this, right? Okay. So we came in, but when we got this trading range, the market never came in because look at the speed at which it moved, right? There was urgency to move the market up. So we failed to come into the trading range before going. So this is just what? To lower your expectations on the trading range. Okay. So in an uptrend, we look for buy entries inside the trading range and target the last high that was formed prior to the move inside the trading range. So we have a trading range, right? We buy inside the trading range in an uptrend. We look for a buy inside the trading range, and then we target the last high that was formed. This is a previous higher high. Okay, this is the last higher high that was formed prior to this move inside the trading range. So we buy here, and then we target this. Okay, so that is what we have here. All right. I believe this is very simple. You buy inside the trading range and then you target outside the high that is outside the trading range, this particular one. Okay. Now, 4, in an uptrend, okay, we look for sell entry. So the first one was about buy entry. Look for sell entry outside the trading range, right? After we broke this one, start looking for sell entries outside the trading range. Okay. And we target liquidity. Okay, liquidity pool or imbalances within the trading range. So here we are going to sell outside the trading range, and then we target liquidity pool inside the trading range. So for instance, this is liquidity pool, this is liquidity pool, this is liquidity pool, and this is also liquidity pool, right? And there's an imbalance here, a fair value gap here. Okay, so we are targeting this. Now, it is that it is important to make sure that the market has traded into a point of interest. And then in subsequent lesson, we are going to look at point of interest, but you have to keep it in mind that to be able to sell in this, because this is an up move, it's an uptrend. So an uptrend is safer to buy than to sell. But if you want to sell, you have to make sure that the market has traded into a point of interest in the previous down move. Okay. And now in this particular one, we have an SC candle here because this candle took liquidity, right? So we can sell here and then target this. And if you look at it closely, okay, if you look at this closely, if you go to a smaller time frame, you will see low, high, low. So there was a BMS here, a shift in market structure, which is a buy down to this level. Okay, that's why the entries are around this level. Okay. All right. Okay, so multi-time frame analysis using the trading range. Okay, so more people use market structure to do multi-time frame analysis. That is to look at it in a way like this. Let's say this is a weekly chart, right? And then this is a 4-hour or daily chart inside it. Okay, and they are looking for alignment. Yes, they're looking for alignment. Okay, so we have a minor break of structure, right? This break of structure suggests the reversal of only this move, right? But okay, then we start selling. If we break this low, this is a break of structure of all this bigger trend. So a pullback, right? This is what we how we do multi-time frame analysis. Okay, but we can do multi-time frame analysis just to get a perspective, the bigger picture of the market using the trading range. So for instance, the first rule is that don't trade the trading range without knowing the higher time frame trading range. Okay, so whilst you are looking at the TR, let's say this is 1 hour TR. Okay, what does it say? What does the 4-hour TR say? For instance, we may have what a trading range that has been unfilled here. This is what the 4-hour trading range or the daily trading range. Okay, so when the market is coming back into this trading range, this particular one, when the market is coming back into this 1-hour trading range, you shouldn't look at this in isolation. You should look at it from the perspective that this pullback is to correct this trading range. So you enter a buy here, you are targeting this correction. Okay, and never forget that the market is in a downtrend. Okay, so if you are inside a trading range, now you are going to trade to target this particular trading, this particular low, like this. Okay, so you can't look at the trading range without understanding a higher time frame trading range. So okay, so now this is a monthly chart. Okay, so on the chart above, I want you to focus on the yellow portion. So this yellow portion, this one. Okay, now look at the market. You have a downtrend, a lower low, a lower high. So when we traded below this, we had a trading range like this. Okay, market came inside the trading range into an order block, and then we came below this. We didn't break it, so this is what broke it. So this cannot be our trading range. Okay, so the trading range is this unfilled level. Okay, the distance between this lower low this last lower low and the last lower high. Okay, this is not a structural point because this pullback wasn't created as a result of price creating a new lower low. So now our trading range is this big one. Okay, now inside that range, we observe void. So we have this liquidity void, okay, or we have this inefficiency imbalance with this big candle, okay, and we have this serving as liquidity. But on this time frame, we see that the whole of this has already been filled, mitigated. We look at mitigation too. This whole area has been mitigated, right? So now there's an imbalance here that hasn't been corrected. So the next thing is that we mark that the market hasn't filled the imbalance. Yes, we haven't filled the imbalance. These imbalances are still there, not filled, and we haven't absorbed any kind of liquidity yet. So now this becomes liquidity, all right, because we haven't filled this, okay, and this is also liquidity, right? But this is a high resistance liquidity. We'll talk about that. Okay, so now, and we should be looking forward to see what price go back in here to absorb liquidity before continuing to the downside. Okay, unless we trade beyond this, then we know that we are not going down again. Okay, so we are bullish on the monthly. Okay, so this one is not looking at small pictures. Okay, we are looking at the whole thing. So the whole thing is that we are bullish because we expect to see the market go back into the trading range to fill these imbalances. Okay, so that's the first thing we can say about what the monthly chart. Now, this is the weekly chart, and this was an extension of that trend that came down. Okay, so on that weekly chart, we can see we had a break in market structure. Can you see? We have a high, a lower low, a lower high, a lower low. Then we have traded above it. So you have a break in market structure. Okay, so with this break in market structure, what do we expect? We expect the market to come back and fill the trading range, and it did. It came back to fill the trading range. So what do we do? If it came back to fill the trading range, we said that what inside the trading range, we look for what buy entries. Okay, so it means that we would have bought here and target this particular high because price came, and as you can see, it filled all the liquidity pools. It absorbed all the liquidity and filled all the imbalances. So there are no more imbalances down here. So this was an area for a good buy. Okay, so liquidity filled. Liquidity has been absorbed. Imbalances have been filled, and the rule says that we buy inside the trading range and we target this high. Okay, so we are still bullish. So we got a BMS from the monthly downtrend, and price came back into the trading range. What was inside the trading range? So we saw liquidity, internal liquidity and imbalances. These are internal liquidity with a dollar sign, okay, and imbalances. Okay, for now, you understand imbalances in the next few lessons. Okay, right. So the question is, was the market able to fill and absorb them? Yes. Okay, so yes, and it went outside, but yet created a new high. But yet to create a new high, okay, we have moved outside the trading range, but we are yet to create a new high. So this is the target. Okay, now we have reason to see price pull back inside the trading range. We have no reason. Okay, so now we have no reason to see price back into the trading range. There is nothing to come and fill. Okay, so we have no reason to expect price to come here. Okay, so all we know is that price has traded outside and we are targeting this particular high. All right. So we can see this is in harmony with what we saw on the monthly. So on the monthly, we're looking at bullishness, right? We're looking at bullishness to fill, and this is, yes, doing it. Okay, so we are in line. So on the weekly chart, we are in line with what the monthly chart. All right. Now look at the daily chart. This is the last trading range. Okay, high, lower high, higher high, lower high, higher high. Okay, so we traded outside this. And now we are seeing that price is coming back into the trading range to do what? To absorb liquidity and then to what? Correct imbalances. So we have liquidity here. We have some form of imbalances around this level. And then the market came back inside. So this daily chart, and this is the daily chart and the current trading range, right? Inside it, we have an imbalance and a liquidity pool, okay? We also cannot ignore the fact that there are imbalance below the trading range. So below the trading range, we already have imbalances. Okay, we already have imbalance. Okay, so we cannot ignore the fact that, right, there are imbalances below the trading range. So there are imbalances below this trading range, right? We cannot ignore that. But in that range, okay, all imbalances and liquidity pool have been filled. This particular one, okay. So we expect price to trade outside the trading range, and our confirmation is what? A higher high, right? So now, because this one has been filled, we said we buy inside the trading range. So this is the area where we are supposed to buy. When we buy, we are still targeting this high, okay. So now, right, we need to confirm break of structure to trade to that direction, okay. Now, this is a 4-hour trading range. Okay, this is a 4-hour. So in this 4-hour, that is this pullback that you are seeing. This pullback that you are seeing is a whole trend. Okay, so on this 4-hour chart, this pullback is what you are seeing here. So we have a low, high, low, not significant. Okay, and this. Okay, so now the current trading range is this and this. Now, I marked this particular one, and the question was that why didn't I use this as a trading range? Because price came down, couldn't go and fill this one, so I don't consider it as a trading range, and I see it as liquidity because they are equal highs. Okay, so now we know the purpose of this is to move to fix the daily trading range. So the purpose of this move was to fix the daily trading range. So you can see these big lines, okay, was to fix the trading range. So if we were trading from here, let's say we were selling from here, we had entry to using to sell from here, our target is going to be the daily trading range. Now, so once it is fixed, we expect price to continue on the uptrend. So we expect to see price but continue to the upside. Okay, this was done long ago. Okay, now we expect price to price we expect price into the range and and possibly a BMS. Okay, so the BMS should be somewhere around this particular level. Okay, so if you don't have a BMS, now here is where most of the important questions are. So here we have a trading range, a trend like this. Okay, like this. Okay, so you could continue going to the trading range and going down, right? Now, since the trading range we're looking at the downside is filled, then we don't expect to see market come back. If this trading range here wasn't filled, let's say we got here, we had this move, this, and the market came back in here, then we expect to sell more to fill the trading range. Okay, so since it has been filled, then we are going up. Okay, so now this is the reason we had. You could go up and still sell to continue this. Okay, but or you could go in and then continue going up. And I think this is what we chose, right? Because the markets on the monthly, the weekly, and the daily was suggesting that what we are going up, right? Okay. So for instance, these are some of the applications where we see that we traded above this high, we had this low. Okay, so this is a trading range, right? The market went up, and you see the sign of exhaustion. Look at how many candles are packed here. Okay, so in here, if you had a chance to sell, you will sell and target this area. So we are looking at what, buying inside the trading range. Okay, and this is what happened. The markets generated liquidity around this order block. Okay, and then went up and came back into the trading. We are still in the trading range. You get a trade, the target is outside the trading range. Okay, now this is another example. This was looking at divergence. Okay, so we have divergence here. Price went back into a breaker. Okay, we drop inside the trading range, and inside this area, we look for what? Buy entries. Okay, so something like this, and then we go up. All right. Now, this is done. The next lesson, we are going to look at what? Momentum. Okay, we are going to look at market structure and momentum, and it's very, very important. Okay, so when our market structure lesson is going to be the market structure, which we all know to be what? Higher highs, higher lows, and all those movement and breaking market structure. Then we look at the trading range. Then we are going to look at what? Momentum. So with momentum, you realize that I mentioned something here. You can see that the market was making highs, right? But there were a lot of candles packed here. Okay, momentum is always a sign of reversal or pullback, okay, or the sign that the market maker is not participating in a certain move. For instance, this one, okay, has low momentum, and you will understand in the next lesson. Thank you very much, guys.